Live from San Francisco, it's the Good Time Show. And now your hosts, Artie and Sriram.
Woohoo! Welcome.
Welcome.
Oh my gosh, we made it to episode 2.
Episode 2.
That's right.
Yep.
We-
YouTube didn't shut us down.
as of yet,
Yep.
we are still coming to you through the pipes of the internet, despite our dear friend Mark's last week's attempts to kind of shut us down. But
True.
thank you again for joining us. We have an amazing show for you tonight
Yeah.
On this Sunday evening.
More guests.
More guests,
Yeah.
more content,
Mhm.
and it's going to be a blast. But if you're joining us for the very first time, here's what's going to happen. So I'm Sriram. This is Arti. And the origin of the show is really about how do we have optimistic conversations about anybody who is building things, be they a founder, creator. We don't care what you're building. We just want to be optimistic about it. And we've both been fortunate enough to have worked in the technology industry for many, many years. And this is our way of giving back. We do this show about once or twice a week around this time, and we bring on friends and folks from the world of technology and entertainment and creators and sports, and we tell you and have a wait for it.
A good time.
Thank you. Trademark right there. And if you want to figure out where to watch us, we are up on YouTube. We are on a bunch of other platforms. We are on all the social media platforms, all of them,
Yep.
and we're pretty easy to find.
Yeah, and we did the first episode earlier this week on Tuesday, and we got a ton of feedback, a lot of positive comments. Keep them coming. We are the Good Time Show on YouTube. You will also find us. A lot of you asked about whether you can listen to it as a podcast. You can. It's now live on. You choose your favorite podcast platform. It's on Spotify and Google Podcasts and Amazon Music and Audible and Spotify and
There are a lot of
everything else.
places. There are a lot of places with audio on the
We
internet.
basically have a really good RSS feed that we can put up everywhere. So you should find it wherever your podcast app of choice is. And you also asked us about upcoming guests. We have basically an editorial calendar, guest calendar going. We have some really good guests coming up. And I think the best way for you to go figure out who's coming up, what the next show is, all of that is you see the YouTube channel. It's a Good Time Show by Arti and Shriram. Just like, subscribe,
Smash the notification, smash the button, right? And by the way, smash the bell. And by the way, there was somebody in the live stream wondering whether this is actually live. And the way I'm going to prove it is I'm going to respond to the comment which says, Sriram, love the haircut. Thank you. I feel seen. Nothing as good as a fresh cut, but thank you. So this is live coming to you from San Francisco.
That's awesome. Okay, I think
So-
what is the show about, Shriram?
Okay, so fun banter aside, this has actually been a really tough couple of weeks in the world of technology and in the world of crypto. And I lost count of the number of conversations I've had with founders, people who work at technology companies, venture capitalists, people who are involved in crypto in any number of ways, who are anxious, a bit frightened, a bit worried. And what we really wanted to do is to try and just have a bunch of honest conversations about what is going on, but really also about if you are in the world of technology, if you're a founder, if you're a VC, if you're an employee, if you just want to build something, how should you think about all of this?
Mhm.
And that's really the idea, because I know it's a really scary time for a lot of us, and a lot of anxiety out there. And hopefully this, even if it doesn't ease your anxiety, at least gives you some color and perspective. And to do that, we try to pull together some of the best people
Yep.
that we know of
Yep.
in the world of venture, in the world of crypto, to talk to us about everything that has been going on. These are people all of you know and deeply respect, and we are thrilled that they took time out on Sunday evening to join us today. So with that, Arti, who do we have on the show?
Let's go around the room. First, we have Elad Gale. Elad is a longtime angel investor, is a good friend. And, we were talking about who's probably the best person from an investor standpoint who could really chime in and talk to us about both, what's happening in the current market landscape, but also in the world of crypto. So we thought Elad would be a really good fit here. Welcome, Elad. Thanks for coming on the show. And then we have
Woohoo!
We have David George, who heads up the late stage and growth investing at A16Z. And, David wrote this really awesome post this week, just covering a very timely too, covering the exact same topic. So we thought he would be a really good person to also come in here on our show. Welcome, David. Welcome to the show.
I have to say, by the way, David might also be one of the snappiest dressers at A16Z. May not be evidenced by what he's wearing right now, just feedback, but he dresses very well.
Then we have Dan Romero, who's a longtime exec at Coinbase, and now he works on Firecaster. And we're going to talk a lot about crypto, this eventful week that we've seen. But just Dan's like we've known him for a while now, and I'm really excited to have him here on video because he's shown up before the audio versions of the show itself. So welcome, Dan. Welcome to the show. And of course, we have Mark Andreessen and Steven Sanofsky, who, were there in the first episode. If you haven't seen it, you should go back and see the first episode. And they need no introduction. I'm just really excited to have them here again for episode 2. So welcome, folks.
There we go. Look at Mark. Mark and Steven. Mark, do you have, what are you drinking? Can you pull it up to the camera? What are you drinking right now?
Well, tonight's whiskey of choice, let's see if this is visible. This is, you'll have to tell me how this is pronounced. How do you pronounce Amrut in Indian?
Amrut.
Amrut.
This is from India, isn't it, if I'm correct?
This is Indian. This is Indian whiskey. This is Indian whiskey made from barley, just like Scotch. This is from India. Yeah, this is one of the best distilleries in the world. And this particular bottling is a combination of peated and rum finished. And it is a flavor explosion. I highly recommend.
That's awesome.
By the way, I have to say, if you're not familiar, Amrit actually means the nectar of the gods, nectar of the heavens.
Lord.
Wow. There we go. I love it. Okay.
Whiskey is Irish for the water of life, and so now we have the water of the life, the nectar of the gods.
Awesome. Well, at least I wouldn't have to Google this because last time you said something and I had to figure out what that whiskey was. So this makes it a lot easier for me for the transcripts.
There you go. All right, let's get into it.
Okay, let's get into it. Elad, question for you. We've had this crazy eventful last few days. You probably are talking to founders, giving them advice at different stages even. What advice are you generally talking to, or what have the conversations been like through the course of the last week to 2 weeks or so as you talk to founders from seed, Series A, Series B, any stage that you're talking to?
Sure, yeah, no, so I'm basically getting 2 or 3 calls a day right now in terms of people who are wondering about the funding environment. What should they do? How should they think about their startup? And it feels a little bit karmic to me because I remember in 2008, I was running a startup and we were 5 or 6 people, and I was running a Sequoia-backed company, and I was invited to the Rest in Peace Good Times Sequoia presentation. And at the time, Sequoia had this big doom and gloom statement about what was going to happen, and tech just took off from that point on. Right. And I think part of that was they just lived through the dot-com collapse, and so everybody was kind of primed to react really strongly to any sort of shift in the macro environment. It feels like this time that statement is actually potentially correct, in that we've gone through a very distorted period between money printing, low interest rates, COVID-related stimulus, and other factors. And now we're kind of paying the piper. It feels like a lot of things in the macroeconomy are starting to catch up. And in particular, we have what appears to be some form of an inflationary environment. And so interest rates are going up. And anytime interest rates go up, anything that you have as future cash flows starts to get discounted at a heavier rate. In other words, if you have a growth stock, you're expecting that growth stock to eventually pay out a lot of money later, but you're investing a lot of money to grow it now. And because that cash flow is so far in the future, it gets more and more expensive from an opportunity cost or money perspective. And so valuations come down for those types of stocks in particular. And so we've had a huge public market correction where things in some cases have come down 50 to 90%. In terms of a variety of stocks, and a lot of the multiples or comparables that would be used to assess a technology startup that's private have come down dramatically. And so valuations across the board in technology have come down. A lot of money appears like it's going to start drying up. And that's hedge funds that have lost huge amounts of money on public stocks that they were holding, can no longer invest in privates. It's people investing on such a large pace that the $1 billion that somebody raised a year ago is all gone now in terms of the venture capital funds. And so it does seem we're about to enter an environment where a lot of different things are going to shift pretty drastically from a funding environment and therefore how companies should act perspective.
So let's maybe break this down. So we want to spend the rest of the night digging into each of this in detail. And, maybe one place to start breaking this down is maybe cut it out by stage. So, I think we're kind of all familiar with kind of the correction in the public markets and how that's maybe impacting late stage valuations. And we're going to get deeper into that. What are you seeing on the seed, Series A, market right now?
Yeah, I mean, the best advice for a seed company hasn't changed, which is basically try to find product market fit and literally nothing else matters except for maybe, don't fight with your co-founder. Those are sort of the two things that you have to avoid that you have to do as an early stage company. And so the advice that I actually got in 2008 from Sequoia was your 5 or 6 people, don't worry about it. Just focus on building a great company in a unit economic positive way. And that's true for any seed company today. Your expectations in terms of round dynamics should modify, right? You should expect that it'll take longer to raise money, or at least eventually. I mean, seed stages haven't been impacted quite that much yet, but it's coming. And that your valuation won't be as high as it would have been 6 months ago. But 6 months ago was sort of all-time highs in terms of seed valuations. If you're a Series A company, you have to start thinking about your Series B. And that means you have to start thinking about how much revenue you're actually going to have and what your growth rate will be. And then whether or not you'll have good characteristics in terms of cohort expansion, your net burn as a company and your burn multiple and other characteristics that people will track to determine the degree to which you're going to get that next round. I think where it gets really tricky or dangerous right now is probably around the B or C round outside of growth, which is, to your point, corrected strongly, because a lot of people raised $1 billion round with $10 million in revenue. And if you look at public comparables, you need something like $100 to $150 million in revenue to support $1 billion in market cap, at least for today's public companies growing at 20 to 40%. And so that really means that the bar has gone up dramatically in terms of what a unicorn valuation means. And so it's quite likely that, a third of the unicorns or half the unicorns are going to really have to be focused on cash management to grow into that valuation over the next 2-3 years.
And I think one interesting phenomenon here is a lot of founders haven't lived through 2008, or definitely not 2001, and and this might be a little bit of correction in terms of both valuation, but also kind of maybe the speed at which maybe you're able to raise a seed or a Series A. I've been having conversations with other VCs, kind of different industries, different firms, where we may not actually see the 1 or 2 day time to getting a term sheet, but you might actually take like some period of time and a lot more process. So does this remind you, I'm guessing, like, what are you telling founders, when they're out to raise a seed round, when you're out to raise a Series A, who may not run this market? Like, what are you telling them? Like, hey, things might be a little bit different now and you have to acknowledge what's happening.
Yeah, the biggest reset really seems to be on valuations. People were used to an environment where individuals were willing to pay 18, 24, 36 months ahead of what was already considered a very high multiple, right? And so people projected into the future on very little data and gave huge rounds. And then to your point as well, what used to be before 2019, rounds would take 12 to 18 months to fundraise. Rounds would be raised every 8 to 12 months, and they take 3-4 months to raise. And that timeline really collapsed, where people were raising rounds every 3 to 6 months for the best companies with no new incremental information. And so people in some cases would do 3 rounds of financings in a year. They'd do a seed round, and then they'd have a preemptive A, a month later, and then 6 months later, they'd have a preemptive B with very little data. And so the positive for those companies is that they're able to last a very long time right now because they didn't necessarily ramp up their teams as much. The negative is they may not have product market fit, and they may effectively be stuck. And in parallel, I think one of the distortive effects of that last environment was at every round, founders would take out secondary. They would sell stock themselves as part of many rounds.
For maybe folks are not familiar with VC terms, could you explain what secondary means?
Sure, yeah. It's basically when you start a company, the company is wholly owned by the founders, and then they start giving stock to employees, and then investors buy a piece of the stock of the company. Usually when you raise money in a VC round for an early round, you are only giving money to the company. The company is directly taking the money in, and that's called primary. There may be circumstances where a founder or early employees or other people may sell some stock as part of a financing, and they get money directly instead of the company. And so one of the things that really shifted is usually you'd wait until a company is worth $500 million, $1 billion, and was sort of clearly working before you'd sell secondary stock. And it was a way to basically incentivize the founders to stick with the company. Because if it took 10 years to go public and you wanted to buy a house, it made sense to be able to take out some money to be able to do that, or to, you know, pay for your kids' schooling or whatever it is that you're trying to support, medical expenses in some cases. And then what happened during this last environment is really early companies that have been around for 6 months, 12 months, 18 months, had founders that were taking out very large amounts of money directly. And that meant that you had a very strong incentive financially to raise the next round very quickly at an even higher valuation and take more money out. Now, most people didn't do this in a malicious way, and it was just part of you know, a new view in terms of what progress for a company meant. But there are some companies which I think now the incentives are really stuck because a founder may have made a lot of money. The company itself may not quite be working. And the question is, what do you do with it? Can you sell it? Are you stuck holding the bag as sort of an employee base and a founder base? And so I think a lot more companies raised very rapidly in part due to that dynamic, although it wasn't always that explicit.
Got it. Okay, so I want to bring David in. So David, outside of being a Snappy Test, is actually one of my closest friends at the firm and in venture. And David, you head up late stage investing, right? Like, could you maybe explain for folks who are not familiar with VC terms, like what that means, and what is it that you do here at A16Z exactly?
Yeah. So late stage investing for us is basically investing in companies after they've found product market fit, but before they become public companies. And so one of the big trends in the technology market over the last 10 years has been companies staying private longer. And as a result of that, we raised a dedicated growth fund about 3.5 years ago to invest in those companies, which is a very different exercise and different muscle and different way of engaging in a lot of ways than, seed or Series A. So that is, I guess that's what I do here, Sriram.
Well, yeah, okay. Well, that's you bring a lot of color to the firm, a lot of character to the firm. But okay, so I think one of the reasons I wanted David here is, by the very nature of his job, he's probably, he's actually dealing with a lot of these companies which have raised multiple rounds of funding and actually having a bunch of these conversations with founders, some of whom we might have invested in, some of whom might be investing in, and really, really exposed to this space. And this week, David and working with somebody else at the firm, wrote this amazing blog post, which we should try and pull up over here, kind of talking about, I would say, the state, how to think about a down market, and maybe David, walk us through maybe what you were trying to talk about in this post.
Yeah, for sure. So Elad and I talk about this stuff all the time, and he covered a bunch of it already, but maybe just to help set the stage a little bit more. So Elad mentioned that, the highest growth stocks are the ones that have been greatest impacted. In the public markets, you can break it down into sort of three big buckets, enterprise software, consumer internet, and fintech. And the enterprise software group is down roughly 60 to 65% off of where they were if you go back to November of 2021. And so if you take the universe of SaaS companies in the public markets, there's now almost 100 of them. That equates to basically $1 trillion of market cap going away since November. And the highest flying recent IPO of any of these companies was Snowflake. And Snowflake's trading multiple, revenue multiple, the way it's valued, I think I saw is down over 70%. And among the highest growing companies like Snowflake, that universe of companies is kind of down 80%. So enterprise software is 60-65% off the highs. Consumer internet is 70% off of their highs. And then fintech has been hit the hardest. It's 80%. I cover biotech a little less, although we have a big bio and health practice at our firm. And that looks like this too. 70-80% or more off. And the crazy thing is, this is simple math. So, bear with me, but like when you're down 80%, even if you go up another 50% after you go down 80%, you're still 70% off your overall high, right? So that's why the magnitude of this is so severe. And even with rebounds, like, in the last couple of days of the week, there were some of the growth stocks that appeared to be, sort of public market investors short covering with, stocks going up 15, 20, 25%. It still barely makes even a little dent in the impact of how far you've fallen before. So anyway, that's the sort of magnitude, and that's how we're talking to our founders about it. It's like, hey, look, like, it was great that we did what we did in 2021, that we raised, and that you were able to get capital from lots of different places. But this is a 60 to 80% correction.
Wow. Yeah.
Look at, even in the largest trillion-dollar market cap companies, like all of a sudden what was, I don't know, like 6 months ago was effectively a bond. If you look at some of the companies now, all of a sudden people are valuing their revenue very low. So what goes into that psychology? Because something like Snowflake, there's the ARR multiple, but then all of a sudden you get people screaming, well, what about profit or net free cash flow? And it's like the rug got pulled out from under them. And how does that trickle down to the Series D and E company?
Yeah, it's a great question, Stephen. Like the goalposts have changed, and they changed like really fast. So it used to be in the private markets and in the public markets, folks paid much more of a premium for the amount of growth that you had as opposed to the efficiency with which you're growing, right? And so, I can't tell you how many hedge fund people I've talked to over the last 3 months. They all have said the same thing. They're like, oh, I just want to buy the stuff that has real cash flow, because at least I can then make sense of the valuation. And so in the case of Snowflake, it's corrected. It still trades for 25 times revenue. And I think they have like 10% cash flow margins. And so, there's no like cash flow multiple that you trade for. And that's made people feel pretty skittish. A couple of companies have come out in their quarterly earnings and sort of reiterated that they're going to continue to invest in growth and not focus on profitability as much. And like the public markets do not like that right now. So it's very much an orientation back towards cash flow now as opposed to growth. And the same thing holds in the private markets. And you can see it in the impact of public stocks, right? Like the ones who have held up the most are the big companies that have a lot of cash flow, like, ServiceNow and Adobe. Ones that have held up a little bit better are companies that have cash flow, like CrowdStrike or Atlassian or Datadog. And then the ones without cash flow, it's been the greatest severity of impact.
So one of the things I'm curious about is, we in a lot of the conversation about this last week, and I was watching a lot of podcasts, the All In podcasts are fantastic content on it. I think David Sachs had this great presentation that he was doing to Craft, a lot of great content on this. And a lot of people talk about the numbers. But I'm also kind of interested in how are founders reacting, and maybe David and Elad, like a lot of the founders that I think you speak to, they haven't seen a market like this. So what is maybe the emotional reaction? How are they processing it? What has been more surprising or more challenging for them, because they haven't maybe seen a world like this before?
Elad, you want to go first?
Early inning. Yeah. I just think people haven't really adjusted to what is likely a new world. And again, it's very hard to make these macro predictions in terms of what's going to truly stick. But the most likely scenario is that we continue to have some interest rate hikes over the course of the year. And there's some world where multiples come down even further. And we still haven't seen companies really blow up and go under at any scale. We haven't seen the down round. We actually haven't seen any real carnage yet. We haven't seen the layoffs at scale, the things that tend to happen when money really dries up. And so I think a lot of people are either uncertain or they're in denial. And which of those you choose depends on what you think the future really holds. So a lot of people will go out with round valuation expectations for Series B, Series C, and then, a month later, they'll go back to the same investors and say, hey, we'll do it at half the price. And those same investors just don't want to get involved because they view it as kind of a failed fundraise, or there may be some employee dynamics where people are still raising very aggressively instead of looking things like their burn multiple, which is how much revenue you're generating per dollars that you burn effectively. And they're not necessarily tracking metrics that give them a real view of health of their business in a way that's really relevant to the shifting world. And so I think people are still adapting, particularly in the mid stage and early stages. I don't know, David, if you
this is the reason that we wrote the piece that we wrote, that Justin Call from the growth team and I wrote the piece, is like to make it like it's just a diagnostics framework, right? It's like a starting point, because a lot to your point, like if you just try and go out and raise the same way as you did in 2021, it'll be hard. So we basically said, hey, look, like it may seem a little abstract to you to say like 60 to 80% correction. Like, what does that mean to me? One way to do it is basically say, okay, I raised at, $2 billion last year and it was 100 times ARR. And if, there's a 60 to 80% correction, that basically means I may need to 4X in order to grow into my last round value. And so at least starting to, put those kinds of scenarios on a page and try to plan your cash runway and see if there's other places where you can get cash to buy you time to get you to that point was the purpose of it. And then, Elad mentioned the burn multiple piece. We benchmarked, I think like 70 data points or something of companies that we looked at and tried to segment it out by stage of company, 0 to 10, 10 to 25, 25 to 75 and 75 or more. Just so founders can look at that table and say, look, how am I actually doing? And how do I compare to the market on that? So, at least those are a starting point for planning.
Right. Okay. All right. I want to switch gears just a little bit. I want to go to Mark, and a lot of people have been like, waiting to kind of get Mark chimed in. I think Mark just been taking swigs. And so Mark, I think one perspective which a lot of people are curious about is the perspective of the VC. And you obviously happen to be in a position where you run a firm yourself, you talk to a lot of folks in the industry. So what is maybe the tone of conversations that you are seeing? And maybe if people ask, hey, how are VC firms now thinking about this? And of course, they all come in different shapes and sizes. What is the mindset at a typical VC firm right now?
Yeah, so the thing that I think is important for people to understand is that whenever there's sort of a macroeconomic shock and then venture capitalists change their behavior, right? There's an immediate critique, which is like, well, why on earth would VCs change their behavior, right, in response to a stock market change? Like VCs are investing in a company, today with the idea that it might go public, but sometime between 5 to 10 years in the future. And so, right, what possible relevance could, whatever the stock market is doing today, what possible relevance could it have on what happens 5 or 10 years from now? And so shouldn't basically VCs just keep doing the same thing? And I think the thing that's important to understand, consistent with what our other guests have been talking about, is basically, the whole investment landscape is a food chain, right? And so when a venture capital firm invests in a Series A, it's right. What's the big risk to the VC that invests in the Series A is that the company won't be able to raise a Series B, right? What's the big risk of investing in a Series B? It's that the company won't be able to raise a Series C. What's the big risk for Series C? It's that the company won't be able to raise a D, and so forth and so on. And then ultimately, maybe the company can't go public. And so basically, as a VC, there is this kind of, it's like looking through the, reverse end of a telescope or something. Like there is this thing where you have to have some sense that the investments you're making now are going to be actually viable in whatever the unfolding, kind of economic environment is. And specifically that they're going to be able to raise a next round, right? And, right, that they're going to be able to raise a next round at a premium to the post-money valuation that you put on the current round. Right, which is right. The price is really important here, right? If I fund a Series A, right, in 2004, a Series A valuation was 9 pre, right? And so if I fund a Series A at 9 pre, so typical like Series A in 2004 was like 3 million in on 9 pre with 12 post, right? And so if I'm investing, at a Series A at a $9 million pre-money, $12 million post-money valuation, the odds that company is going to be able to raise at 20 or 30 posts, right, for their Series B is, probably pretty good. I don't know about you guys. I can't remember the last time a startup raised a Series A at 12 posts.
I know. I was going to say, I was like, which year are you talking about? Because that hasn't been a typical round in the last year, at least.
Not many years.
Exactly. The more typical Series A in the last 12 months was like 120 posts, right? It sort of crept way up over the last couple of decades. So, and basically founders got used to being able to raise these, turbocharged rounds with these super high prices very quickly. But then the consequence is, right, if you're raising at, 120 post or 80 post or 60 post, there has to be somebody else out there who's going to write a check at 150 post or 200 post. That person is going to look forward to what happens after that, right? And so it's this dominoes kind of cascade thing. And then, by the way, along with that is just, your previous, guys talked about this, but, it is this thing of like, okay, like, do these rounds happen super fast? Do the term sheets get sent over with like, the numbers filled in, right? Like a lot of the sort of exuberant behavior that a lot of the exuberant behavior of the last few years assumed that it was sort of infinitely easy to raise infinite amounts of money at infinitely high valuations down the road. And to the extent that assumption is changing, which, at least right now it is changing, then that ripples all the way back. And so that's the thing. Now, having said that, from the standpoint of venture capital, of course, the risk is that you pull back during the down market. Right? The risk is now, the risk is like maybe now is exactly the time to really focus on venture, and especially early stage venture, seeds and Series A's, because this is an environment in which a lot of people are not going to be willing to start companies. A lot of people are not going to want to leave their jobs to start companies. A lot of your other VC competitors might pull back. And so there is danger in not being in market. And at least, speaking for our firm, we continue to be in market. We continue to be in business. We will continue to do rounds. We'll continue to make investments. But if this downturn in price and economic activity continues, then prices will definitely reset. And I think it's fair to say, I'd be curious what our fellow panelists think. But I think it's fair to say there's two kinds of private tech rounds happening right now, at least that I can see. There's the ones happening at the old prices, which, it's like people are either still enthusiastic, or they're rounds that were already like almost done by the time things changed, or they're rounds that aren't happening. What isn't happening yet, or at least what I haven't seen yet, is rounds happening at the new prices, which seems like it's the next thing the next card that will turn over.
Got it. Wow.
Yeah.
Okay.
I'm curious, like Eli, like what are you saying? I think there's kind of a theory that there is no maybe like drop in valuations, is maybe either your round gets done or it doesn't.
It doesn't.
I think it's a really mixed bag, and it depends on the stage. I think for later stage growth rounds, you're definitely seeing certain things not get done, or certain things even getting repriced in some cases by the founders, where they'll go back and say, hey, I actually don't feel comfortable with this valuation. I don't think I can exceed it based on the money I'm going to get, and so I'm going to actually reduce valuation. And I think that's really wise to do right now. I think the mid-stage rounds are really split, to Mark's point. Some are white hot, some are not. And then I think the seeds are largely still happening. The only retrenchment I've seen on the seed side was a really high-priced crypto seed, which was supposed to be $5 million at 50. And the founder just emailed me saying, hey, I'm actually going to reset everything, and we're going to go at 20. And he similarly decided to do that. But that's the first time I've seen that on the earlier side. And so I think the parts of the early side market are starting to catch up. Parts are still quite exuberant, and I anticipate that it'll take a little bit more time for all this stuff to cascade through. I think a lot of people still haven't seen their peers fail at fundraising, or really have heard that these things are happening in a bad way, and it's going to take some time for all that to get.
Got it.
If I could add, if I could add to that. So, the last few years have been characterized by let's say a fair amount of, various terms, aggressive marketing on the part of startups raising money. Jockeying for position? Maybe we would say bluffing. Maybe some people would say lying. Maybe some people would say even worse things. In the sense that, basically what every VC and late stage investor has heard for the last few years is every deal, right? Every deal's white hot. Every deal has multiple term sheets from other firms. Every deal's just about to close some high price thing, right? Every deal has this, every deal has that. And so it's basically been this thing where there's an entire generation of founders who basically have been trained to generate FOMO, right? If you're missing out on the part of investors. And it's actually really funny, because they all do the exact same thing. They're like, well, the classic lie of the last 5 years has been, well, we weren't going to raise money, but, right, we got an inbound term sheet at precisely the time we need money, by the way. So, and it's funny, because all these founders, the founders don't realize, right, it's one of these collective action things. The founders, each individual founder doesn't realize that all the other founders have gotten the same advice. So they all show up with like the same BS line to try to generate FOMO.
By the way, my favorite move that somebody pulled from, who shall remain unnamed. This person accidentally screen shared, quote unquote, their calendar we just accidentally had back-to-back meetings with pretty much all the top venture capital firms, and they were like, "Oh, oops, I didn't mean to show that." And I somehow don't see that happening these days.
I had friends who did that 15 years ago, so that's a very old tactic.
That's an old tactic.
now it's
Yeah,
it's like the shared Google data room that everybody else can see who else is in there. That one happened to
or if it's or if a consumer app, it's the early preview access in which all of the other users are all the other VCs.
Yep.
Right, and so basically it was a whole world sort of advice. This whole ecosystem of advice formed at generating FOMO, and I did a little Googling right before the show. There are several nominations for the opposite of FOMO, but my favorite one is JOMO, JOMO, which is joy of missing out. And so, right. So to the extent that we're undergoing a shift from FOMO to JOMO, it's going to get a lot harder for a lot of people to sort of run these plays, right? Because the assumption is going to go from, oh, every deal's hot and every deal has multiple term sheets, to, oh, no deal is hot, no deal has term sheets, nothing is getting done, the prices haven't reset yet, everybody's retrenching, everybody's looking to support their the companies they're already invested in, they're husbanding capital to support their existing companies. And so if this really is this big of a shift, it's going to be a shift at JOMO. And then in that case, just, even when rounds happen, number one, they'll happen at much lower prices, but also they're just going to take a lot longer, right? There's going to be a lot more, and the older people on the call will remember, 15 years ago, you as a VC, you had a long time to look at a deal, right? You could often be looking and kicking the tires for months, and not that that's good. I'm not saying that that's necessarily the environment you want. But when you really go to the other side of this, the power balance really shifts, the tactics shift, the way the deals get negotiated shifts. And so I would, as an entrepreneur, let's put it this way: if you have a high price round that is in the pipe right now that you can get closed, close it.
Close it.
Right? Because it is likely that over the course of the next several months, the behavior on the part of the VCs will change quite a bit.
Got it. Yeah. Dan, yeah, sorry, Stephen, go for it. Why don't you finish your thought?
Should I go for it?
Yeah, go for it.
I'll go for it. One of the things that I like, speaking of older people, one of the things that I keep hearing that I find pretty interesting is just this desire. Am I already being made fun of?
Well, I was going to make a joke about the older people thing, but you went there yourself, so just keep going.
Well, at least I don't have to go through the haircut problem. But the thing that I keep hearing is this desire to sort of have as a coping mechanism let me tell you, I've been through 2008 and I've been through the dot-com bubble, and so let me tell you how this is going to play out and how what we're dealing with now is so analogous to the past. And I have to admit, I think that that's just super weird, because I mean, maybe everybody else has an idea of why it's like 2001 or something, but nothing feels at all the same.
I think you mentioned this before. Why is it not okay to compare against, say, a 2001 or 2008?
Well, I'm not a macroeconomist, but I can probably make stuff up as good as a lot of them, which is just that it's, we have a whole set of different systems going on now. Like we have a war, and we have shortages, and we have a supply chain. We have the banks in a completely different regulatory environment than they were in 2008. And in 2001, people go, oh, but you see, those companies weren't making any money. And everybody, for the past 5 years, everybody's been saying that, no, these companies are all making money now. But to David's point, they weren't making money. They just had cash flow. And so I'm curious, that to me is a coping mechanism on the investor side, is to act like I can be calm because I know how things are going to play out. And I don't think it's like that at all. Maybe other people have this clear model.
Well, I would say there's a general problem, which is there's a general problem in trying to understand the present, which is the sort of perceived need or appropriateness of reasoning by analogy, right? And so you see this a lot in basically politics or world affairs, right? Which is every war is World War II, right? And every dictator is Hitler, right? Since 1945. And by the way, before World War II, right, every war was World War I, right? And so forth and so on. And so, so for people in the current environment, you hear this a lot, which is basically from young people, it's 2008 all over again. From slightly older people, it's 2000 all over again. If you talk to people who are in their 60s or 70s, they will be able to index against, 1992, or they might be able to index against 1981, or 1973. And then if you read books, you can go back and you can index against crashes in the 50s and then all the way back to the 30s, right? And all the way to 1907, right? And so history has many different many different things have played out. There have been specifically many different stock market crashes. There have been many different recessions over time with very different patterns. And Stephen, I think to your point, I think the key observation is the mix of factors is different every time. And so the odds that whatever we're going through now is a literal repeat of anything that happened in living memory is very unlikely. And in fact, it's more likely that not only is this not like the prior two, it's probably unlike anything that has ever happened before, precisely because the mix of factors are different. And yeah, I think that's a very, very good cautionary message. And then that relates a lot to point I kind of hit on the last show, which is like prediction is not really useful. Like there is nobody who can tell you what's going to happen next. And every single economic thing I've ever been through, there have been a lot of highly credentialed experts that have been completely wrong in their predictions. And so I've seen this with my own eyes. And so nobody can tell you that this is going to be a major crash that's going to last for 5 years. Nobody can tell you that it's going to be over tomorrow. And so, and this, I mentioned this last time, but like a lot of the thinking here should be less prediction based, should be more scenario based and contingency planning based. And basically really wrapping your head around the idea, like you can't forecast the future, but you have to be ready for the different scenarios.
Yep.
Yeah. I think that's a super key coping mechanism is just this, it's not going to be over in a month and it's not going to be over in a year, but it is going to be over. And so the whole idea of just planning for it to end but not know when versus thinking that there's some timeline. Like I've heard a bunch of people like, well, as soon as the Fed gets to 4% or as soon as this, like there are these specific triggers that some people have in models that sort of indicate when the whole thing is going to end. And that isn't how it's going to go. And so to David's point about burn, like having a model for how long your cash can go for that's sustainable seems to be the key thing right now. In his post, he has sort of like positive, negative, and super positive sort of expectations about how to and multiples for how to measure that. I think is really a helpful guide.
I wanted to get Dan's take on this too. Dan, you've been you were an exec at Coinbase, much bigger company. Now you're a founder. And how do you think about it from the last couple of weeks, but also looking at this like magic 8-ball, like what happens down the road for you as a founder, but for also like for anybody else who's just about in the stage of like starting something. For me personally, I actually think this is like it's a great opportunity to be like really aggressive and go for it. But how would you think about it?
Yeah, so I think having grown up in crypto, it feels a little weird because for the last 10 years, the rest of the tech industry hasn't had a downturn, but crypto's already had two. And I've had, they call them crypto winters, but there were pretty lean times at Coinbase 2014 to 2017. And then after the euphoria of 2017, things came down pretty hard in 2018 and 2019 to the point where, revenue corrected, almost 80%, right? Everything that you're seeing in public markets has already happened multiple times in crypto. And so I think there was always a mentality that you didn't know, kind of trying to predict the future was not going to be a useful exercise. And so there was always kind of okay, how much cash do we have? Like how long do we, what the runway calculator that I think it's like Y Combinator or Paul Graham has is like, are you default dead? And that's something that Coinbase, even in 2018, 2019, was running at board meetings of like, okay, how much cash do we have? And the ability to fundraise in 2019 for a crypto company, no one was interested in it. And then obviously the market got really excited about crypto last year, and Coinbase is back down to where it was in 2019. So I think that there's a mentality that crypto people who've been around for a while, they've seen these cycles, and it's kind of interesting to have it apply to.
Does it just mean you have thicker skin now to deal with this? How do you think about it as you're starting a company now?
Well, I mean, a lot of the advice that everyone's been sharing is pretty practical. I mean, ultimately, if you don't have enough cash to survive as a company, whether you're Series seed or Series D, it doesn't matter. And so I think I'm friends with a lot of founders at different stages, and what's interesting is a lot of the later stage founders that I know, they haven't done layoffs yet, and there's a variety of reasons. You know, it's a hard thing to do.
Yep.
It's somewhat embarrassing feeling, or and obviously the employees that you care about. But the reality is, like, if you have to do that hard thing, you should do it as soon as possible.
You should just do it.
It's going to extend your runway as much as possible. Now, obviously, if you're at a more early stage, all the things that have been said about prices for rounds and things like that. But ultimately, I think people need to kind of figure out, okay, what do I need to do? And in the case of crypto, I think we could be in a crypto market that's sideways for a while. And so then it's like, okay, what do I want to accomplish over the next 2 or 3 years, and then try to make runway that might have been originally planned for a year or 18 months last as long.
So, but we're going to spend a lot more time with Dan on crypto, just a little bit too, because I think that's it's been quite the eventful week there.
Yep.
But I want to kind of maybe change perspective, because we've been talking about tough decisions by founders. And a lot of people are going to be watching this and listening to this are not founders. They work at these companies. And it's an understatement to say that a lot of people who are very anxious, who are afraid, maybe for their jobs, or maybe for, hey, what's going to happen? Maybe the price, what's the price of the options that I got at? Is it actually worth so much?
Yep.
The RSUs, or just kind of general uncertainty. But one question for the group, maybe I'll start with Elad over there and then kind of go around, is when you talk to an employee, right? Like maybe they're an engineer, a marketing person, doesn't really matter. Like, how should they think about this market, right? Let's say in a growth stage company, and then maybe working your way backwards to an early stage startup. Like, how should you feel right now?
Think about it. Yep.
Yeah, it's kind of funny. I went through this myself in 2001. I was at a startup that grew from 120 to 150 people, and then it shrank to 12 people over 5 rounds of layoffs. And I think I was laid off in like round number 3 or something. And at the time I was working with this guy, Gokul Rajaram, who's pretty well known in Silicon Valley now. And I remember actually pulling him into my into like a office and walking through the numbers with him in terms of the burn rate of the company and how we were going to be out of cash in 6 months unless they did a layoff, and therefore we should anticipate one. And so I think a lot of employees, if the company's open with information, will increasingly have awareness of what's coming just based on the numbers of the company and what's sustainable versus not. And I think as a founder, you want to get ahead of these things and be, proactive about communicating things as they're about to happen. But as an employee, I think you should also be thinking through 3 things. I mean, one is obviously you may have very deep loyalty to the company and you may want to contribute in certain ways. And it's worth at some point talking to your manager or to the management team or founders about how you can help contribute to making sure that things end up working out. I actually offered to work for free in 2001, in part because of the bleak environment, but in part just because I wanted that company to survive. I think the other piece of it is, if you do decide to make a move, you should think through, what business are you going to go to? What is its capital efficiency? What is its burn rate, et cetera? I don't think, again, things are quite at that. Everything is dire and bleak moment. During every downturn, there's lots and lots of companies that thrive and they get leaner and they get more capital efficient and they get better at what they do in all sorts of ways. But there also should be a set of companies that are clearly ahead of their skis and don't have clear product market fit or have a very inefficient sales structure or something else that's really going to lead to a bad spot. And you have to kind of figure out which of those companies are you at and then what should you do based on it. It will become a good time to start companies from the perspective of you will have less competition and you'll be able to hire much easier. But the flip of it is going to be harder to raise money, and you may or may not be in a situation in your life where you can take that risk. And so, it really just comes down to figuring out what makes sense relative to, those different factors.
One of the comments that we're getting is this is such a dark, gloomy, somber episode.
It is,
and that maybe that may just be kind of the nature of the world we live in now. But I think and maybe I want to go to Mark on this. Is Mark? I think one of the comments you made in the past is, if you look at previous downturns, some of the iconic tech companies that we use every single day came from some of those downturns. So if that is light at the end of the tunnel, if that is some level of hope to be found, like what would it be?
Well, they say sometimes the light at the end of the tunnel is the oncoming train.
Thank you.
Oh my
Thank you. This
goodness.
was not helpful. Not helpful at all.
Okay. All right.
There's that optimism,
All right.
Mark.
Okay,
Way to go.
Okay, let's see. I have a bunch of those. I'll stop at that one. So, yeah. So look. So here's the good news. So the good news is it is true that a lot of the best companies are born during downturns, or actually grow a lot during downturns. And so there's many examples. I'll just give you a couple. One was Dell, which became the dominant personal computer company of the 1990s. They literally started in the teeth of what was a catastrophic crash in the startup world, in the PC world. Hardware world in the late 1980s. Intel almost went out of business around the time Dell was getting started. Like, that's how bad it was. That was an example. Google, started at the height of the bubble, or whatever we call whatever happened in 1999, bubble or whatever it was. Google started in 99, and while there was just huge carnage in 2000 and 2003, Google grew very fast through that whole period. Facebook started in 2004 when things were still very dark, and then obviously did very well. VMware, probably the single most iconic enterprise software company, of the last 20 years, started also, basically they started, I think, in 99, but also their core growth years were 2000 to 2004. So there are lots of examples of this. The reason why this is the case, I think, is a couple-fold. One is if you have a startup that's funded during a downturn, you're just going to have a lot less competition, right? And that basically does two things for you. One is you're competing with fewer companies for talent, right? Which has been one of the big problems the last 10 years. It's been hard to hire because so many companies are funded, so many companies are hiring. So in a downturn, there are just fewer employers hiring and fewer competitors hiring. And then also the other thing that happens during big booms, which has definitely happened in the last 10 years. Is that the unit economics of many categories really suffer because there's just too much venture money, too much growth money, too much public money, funding 30 companies per category. The companies are all chasing revenue growth. They're all pursuing revenue growth unprofitably. They're all spending way too much on customer acquisition. During a downturn, that stuff all gets wiped out. That gets normalized. And so for the surviving companies in a category, their unit economics often get much better. Now, having said all that, again, I don't want to be too depressing, but I don't want to make this sound like this is a panacea or like some sort of magic formula. Like, it's not a guarantee, right, that people have a good experience during a downturn. Like, the reality is, in a downturn, most companies fail. And so the companies that have these amazing stories like Dell and Google and VMware, they are the exceptions. And they do go through the hard version of being a startup. Like, they go through dark times. There's a lot of stress in the system. And so it definitely is doing it the hard way. But for people who are really determined, right? And, there's always kind of this big question: how many people are doing startups because they like the idea of doing a startup because it's a cool and fashionable thing to do or an easy way to make money, versus how many people are really in this to build something and are really willing to gut through pain in order to build something great. And for people in that second category, downturn environments can have some amazing outcomes.
I think there's a really interesting thing that isn't discussed that much in terms of, to some extent we've had 20 years of boom time in tech. At least from my perspective, and Mark and others may have a different one. 2008 wasn't really a technology recession. It was really a financial services issue. And while there was a really rough recession in the country, it didn't really impact the technology industry that much. I think what that led to is all sorts of drift in terms of what is the purpose of a technology company and what should employees care about or not care about, and how many types of kombucha should you have, and all the various other aspects of running a company today. And I think that a downturn will break a lot of the sort of fragility that you see in people in terms of, when I got laid off, it was awful. It was really tough, but those sorts of experiences do really drive a different perspective, a different emphasis on what's important. And I think at the company level, for certain companies, this is the moment where you can really reforge the purpose of the company and the emphasis of the company and how you win in the market and everything else. And so, to some extent, it could also be a moment of change in all sorts of ways in the industry that, aren't discussed that much.
One of the things I
go for it.
Yes,
go for it, Steven.
One of the things I think that is super interesting and optimistic now too is that we're in an era where, if you go back to 2000, 2001, like there were a bunch of companies that did software and a bunch of companies that made things and had no interest in software at all. But now, Mark, Software Eat the World essay, we are there now. And so everything cares about software. And so especially in the enterprise space, no matter what happens over the next few years, if things take off all of a sudden and become great, then people are going to need software to manage all that. And if things get really, really difficult, then people are going to look to software to automate, software to improve the situation. The supply chain is a giant software problem. Like all of these things are software issues. So there is this core demand for software to get us to the other side of whatever this is, and whether it's short or long term. And I think that is one of the complex systems variables that's incredibly different now. Because what happened, say, in 2001 was a whole bunch of people just went, well, this is why software is stupid. And now I could go back to my analog world. And I think that there's a real possibility that, those in the enterprise software space, which is where I think about a lot, are, they're going to see a lot of interest if they can attack the problems that really matter to working through whatever it is we're in, and for however long it is.
Yep.
Okay, so as bad as it feels, I was just gonna say, as bad as it feels right now, like especially in your world, Stephen, in the enterprise side, like business performance is still really good, and relative to previous downturns, the business models are way better. Like subscription-based business models, multi-tenant software, consumption-based billing, like these are all like really, really, really strong businesses. And yes, later stage companies and public companies may have tilted too much in favor of growth versus efficiency and all that, but they have great business models.
Yeah.
The counter argument, I can't resist. I'm sorry. The counter argument is never underestimate the ability for an incumbent big company executive to find a reason to not go after something in technology.
Oh yeah. But also that works. The funny part about that, Mark, too, is I think it works in the technology companies too, because to David's point about the larger companies, one of the first things that they're going to start to do is not look at any place that they're not currently in. Yeah. And so to Elad's point, that makes the opportunity for startups. And to the big companies, that's how they get their ratios back, is by like jettisoning a bunch of stuff. And so you go through these awful, bizarre experiences where all these people appear to get laid off, but really just got reassigned to other parts of the company. Yeah. And so it is totally like that. Like it's a very real dynamic where even the big software companies will forget what they're there to do.
No, totally. I feel like, as for founders, I really think this is a good time. As hard as it sounds right now, and fundraising might be hard and all of that, but if you're able to stick through this period, I really do think this is a great time to be a founder, especially if you have something that's like really interesting. You can pull it together with like your team of people who can work on this, and as Mark said, like grit through the hard problems. I really think this is a good space because, to Stephen's point, I think the big companies, this is a time when they're like consolidating into their core business, not really looking at the adjacent markets or things that might be a 20% project somewhere. Those are not that interesting right now.
Yeah, one consistent theme of the Good Time show is everyone likes to shit on the incumbent large tech companies, especially Mark and Steven, those two right there. Okay, so I think I want to wrap up on this because we have a lot to cover with crypto. And so maybe one thought I would love to get from each one of you in the grid in front of me is if you're a founder, aspiring founder, current founder, listening to this tonight or in the days and weeks to come, what is one thing that you'd want them to where you want to leave them with? And maybe like David, we'll start with you.
Yeah, I would say like start the scenario planning exercise, right? Like because that's what will make it tangible. And to Stephen's point earlier, all you can do is, in such a period of uncertainty, is start to have various scenarios that you can plan around so you can make business decisions as they come along and conditions change.
Yeah. I totally agree. And in fact, I think that's kind of the conversation I had a lot of, the founders that I've been working with, and I know a lot of other firms have had too, which is, hey, what's your burn? What's your runway? And, if that runway is like below 24 months or so, we should have a conversation. I know that's been happening pretty much every firm and every set of founders. Okay, Elad, one thing for founders.
if you're an early stage company, all you should be focused on is finding product market fit and not fighting with your co-founder. If you're a late stage company, you should be managing cash and figuring out your runway. And if it makes sense to eventually sell, you should do that now.
Wait a minute, is that always true? Like, is there ever a good time to kind of be like, I don't know, bickering with your co-founder?
There never is, but those are the two things that blow up early stage companies. Back before every company coming out of YC got funding immediately, kind of thing. I think it was Paul Graham used to say that something like 30% of the companies would die before they got out of YC, and you'd see these teams sort of reform and restart because so many of them would die. And so actually one of the biggest indicators in some sense of good times perhaps being overly good is that all the YC companies got funded every batch. Mm-hmm. How could hundreds of companies get funded every batch? There should be some bad companies, right?
That's true. Okay.
And in fact, there are.
Well, wait your turn, Mark. Hold your horses.
Sorry.
All right, Dan.
So many rules.
Figure out ways to increase runway.
There we go. Yeah. Okay, can't dispute that. Steven?
I still would say make sure to not stop innovating and to not sort of collapse on yourself and to just keep finding new things to do. But think hard about creating a new product line in this environment where the customer acquisition costs are really going to kill you if you're trying to spread yourself too thin on a whole new thing.
Yep. Well, Web3 might be able to help you there, but I'll stop myself. Okay, Mark. What? Last but definitely not. I'll get my Web3 plugs in later. But Mark, definitely last but not least.
Yeah, so don't predict, don't listen to predictions, scenario plan, contingency plan. Don't let anybody tell you they know what's going to happen. And then, look, runway. I'm just going to repeat it three more times. In the scenario in which things get dark, almost every company wishes later that they had elongated their runway. They almost wish they had done things to, we're in that point. We're in the point where people are saying we're not going to increase our burn rate. Right. And it's like, tiny little applause. Right. It's like, we're going to keep the kombucha. We're going to keep the kombucha bar. We're going to keep the masseuse, right? We're going to keep the gourmet vegan chef. Like, we're going to keep like everything we have. We're just not going to increase any of it. It's like, that's not, okay,
I
good.
feel like that's like I don't know. That feels like a made up thing. I don't think anybody's ever actually had a masseuse. That seems like a made up fantasy.
Google had them.
Google way had masseuses. No question.
In Tony Fadell's book, it's after 11. Tony's book has a whole chapter called "Fuck the Massages."
Oh wow, that's crazy.
Okay.
Yeah, Steven, I think someday we should do a separate episode on this, on like just the books that you recommend, because Build has been great, Play Nice but Win has been great. Yeah. Total segue, but yeah, Mark, go on.
Yeah, so look, runway. Like if your last round, so I think Steven said it early on. If Eli said it, if your last round was 100 times ARR or whatever has been happening, like you're not clearing the post. You're not raising another round that's going to clear that post anytime soon. Like that's not going to happen. With only very rare exceptions. Probably deals that are already underway. And so runway is if the negative scenarios unfold, runway is going to be critical. Staying alive becomes the order of the day, and as the old VCs would say, cash is more important than your mother. And so keep the keep runway, and at some point, like hard looks at cost structure, hard looks at exactly what's required. Team size, composition, and then all these other, like the level of inventiveness in the last 10 years that companies have found to spend money is just staggering. And like it may be time to go to a little bit more of a Spartan mode of existence here, to build for a long-term survival and success rather than short-term, say, creature comforts. And so it may be time to get out the sharp pencils, put on the eye shades, and start to really rethink how you spend money.
Okay, batten on the hatches. Think about runway. Find product market fit. Don't fight with your co-founder, and no massages.
No massages.
No massages. That seems.
But also, I think
you can give yourself if you reach like this, it's two advantages. You get to stretch your shoulders, which is good for RSI, and then you can also give yourself a massage.
This is going to become I just want this to become an internet meme, like right here, like there we go, right there, right there.
I can't tell you how good this feels.
I
here's
think
a yoga
Mark
one. Do
should
this.
lay off the Amrut at this point.
Yeah. There we go. Yeah, we need to get Mark off camera. Okay, changing gears,
Yeah.
and ideally wanted to have Dan on for this part of the conversation.
Yeah.
So, outside of it being kind of like a really down, depressing week, just overall in the market and for a lot of late-stage startups, it has been a dramatic week in the world of crypto.
Yep.
And I think maybe we should quickly summarize what happened there.
Mm-hmm.
But the reason I want to have Dan in is because I think for a lot of people who are new to crypto, I don't think they've seen this before.
Yeah.
And one thing I really love about Dan is Dan's actually been here for many years.
Yep.
He's seen it all. He's seen all the cycles. He has all the scars, and to prove it. So Dan, so maybe and maybe we can quickly summarize for us what happened
in the last week or
the last
so.
7 days in crypto.
Yeah.
Sure. So I don't think getting into the specifics of any one asset is productive as much as there was a high-profile top 10 crypto asset that imploded, and that had a knock-on effect to Bitcoin. And Bitcoin, for better for worse, anytime the price moves of Bitcoin, it's going to impact every other asset in the space. And so you had I think it was a 25% correction in a very short period of time for the price of Bitcoin, which is already down from the highs of what I think was in November or December of last year. And I think a lot of people, for the first time in a while, are now saying, oh, okay, maybe this is actually a crypto winter. And for those who are maybe less familiar with those terms, it's kind of a crypto speak term for essentially the down part of the cycle. And I think I had mentioned before, while tech had a great 10, 20-year run, crypto has had these kind of boom bust cycles. And there were even a couple before I even got into crypto in 2014. I actually joined Coinbase thinking that it was kind of an up and to the right company, only to find out I was joining at the bottom, or kind of coming down off the 2013 Bitcoin cycle. And so we then kind of had this sideways market where really there was no growth in the industry at all. And a lot of companies either couldn't raise funding and either pivoted, sold, shut down. And one of the things that I think people don't appreciate is Coinbase just stuck with doing what it had been doing in the previous cycle, which was allowing people to easily buy and sell Bitcoin. And we added Ethereum to the platform. And then 2017, one of the reasons the company was able to take off is it's just one of the few companies left standing. Obviously there was product and a whole bunch of things, but the reality was the market took off, and most of our competitors, when I joined in 2014, had stopped. Like a bunch of them had pivoted to enterprise blockchains, other ones completely out of crypto.
And I just wonder, how did it feel inside Coinbase, right? Because you're there, all of you kind of had storied tech careers, and the world seems to be falling apart. People are leaving, obviously, and people even question, is crypto going to be a thing? How did it feel emotionally for you to kind of and for you, and I think a lot of other people in crypto kind of stuck it. Like, how did it feel for you during those years?
It was brutal. I mean, I got close to leaving, honestly, and I think part of it was we felt really helpless because the core of the business is people are buying and selling. So you actually have to get people to part with their money, and they have to want to buy. And at the time, it was just Bitcoin. And if the price isn't moving around, it's really, really hard to convince people who are already not convinced about Bitcoin to buy into it. And obviously, it was earlier in the kind of life stage of Bitcoin. So I think the last winter was a little shorter, but I wouldn't anticipate whether or not we are in a winter now. It could be longer, shorter. I think what was helpful was Brian and Fred were both very committed to the mission of the company. So I don't think we got distracted with a bunch of kind of the shiny, bright objects that some of the other companies in the space were focused on. So we continued to grow the business in terms of adding new countries, like allowing people in Europe and overseas to be able to buy Bitcoin. We added Ethereum. But I joined as employee 20 in 2014. By the end of the year, we were, I think, 60 or 70 employees. By the end of 2015, almost 50% of those people had left, right? Like they just kind of said things over. And so, yeah, we backfilled, but the growth was pretty slow. A lot of people left. And I remember we finished 2016 on kind of like an up, like a little bit up, and we thought it was just absolutely amazing. And then the next year we had 100x revenue growth, and that had, again, nothing to really do with what the company was doing. It's just the market picked back up. And I think that, I left Coinbase in 2019, so I wasn't there for the full winter this last time, but I think roughly similar. But I think that the key thing for a company like Coinbase and other companies in the space who had survived, was they had already seen a winter. So you had all these kind of like older employees kind of be like, okay, let me show you how you get through this hard period.
Yeah, there's a great meme, right? Like, with the noose around your neck, well, there's this famous movie meme saying like it's first time.
Yeah, basically it's, everyone first time. And a lot's been through it, right? So he can kind of share his thoughts.
We have established on the show that Elad is old today, I think, right?
I've lived through everything, young man. Don't talk to me like that. I have a question, actually. So if you look at a lot of crypto cycles, historically, people said that they basically correlated to block rewards on Bitcoin dropping in half. And that's when you'd have like supply demand kick in, the price of Bitcoin would run, and then you'd move into Ethereum, and Ethereum would run, and then you'd move into the altcoins, and the altcoins would run. It was kind of like the traditional view of it. And if you look at this cycle, the last halving was in 2020. And then usually there's like a 4 or 5 quarter period, and then everything starts to drop, and then you end up in a winter and everything goes sideways for a while. That's kind of been the traditional pattern. And just through coincidence, that timing is exactly roughly now. I was just looking at sort of a predictive chart on it from like a year ago that was predicting that we'd hit the crypto winter right about now. Do you think it's purely like shifts happening more around the interest rate environment and tech selling off, and therefore crypto selling off is effectively a tech asset? Or do you think it has anything to do with that broader sort of supply demand curve? Like, is that still relevant, or was it ever?
Yeah, I mean, look, a lot of credible people that I think are, pretty smart, and to Mark's point, predictions are always hard, but a lot of people point out that the halving is the closest thing crypto has to monetary policy, right? You have the Bitcoiners who are like, we really don't like the Fed, but the reality is Bitcoin at an algorithmic level has a monetary policy every so often. It roughly correlates with every 4-ish years. The new Bitcoin issued to the network every 10 minutes cuts in half. And so if the price is stable and you believe that people who are mining Bitcoin are really trying to sell it, then it's a relatively plausible theory that you're effectively reducing the amount of new supply. So therefore, any of the existing buy demand, if the price had been flat, is going to increase the price. I think what's a little different now, and you definitely saw a lot of this last year, is so in the previous cycle, Ethereum was the new kid on the block, and Bitcoin was there. And obviously Bitcoin in 2017 had that huge run up towards the end of the year to, at the time, it seemed unfathomable 20,000, which now, if it hits 20,000 now, people will be apoplectic. So a little perspective. But I think the thing about crypto, and you have the term Web3, it's a lot bigger of a category in both that you have the entire Ethereum ecosystem, you have this, Solana and a whole bunch of other kind of like what we call L1 chains, but then you have NFTs, right? It's its own whole category. And so I think I'm curious how this will play out. I think that the simplest answer is, hey, it's all correlated. It's still a relatively kind of immature but growing market. So if the kind of major assets like Bitcoin and Ethereum are a little down, everything else is going to trade down. But if you want to say this time it's different, I think the amount of just like entrepreneurial and creativity that's happening with things like NFTs or like music NFTs, like there's just all these kind of new things that for the last, I don't know, decade, we really have only just had these kind of like money assets. And yeah, NFTs were a thing in 2017, but they were much, much smaller. Whereas I think now you kind of see the amount of entrepreneurial talent coming into the space. As someone working in crypto and Web3, like I'm just blown away by the amount of interest from engineers working at more traditional tech that are still interested, right? Like I don't think that the price, and maybe that changes in a couple of months, but right now it's like people are still fired up about building stuff on this kind of
Why do you think
greenfield.
that is, Dan? And we've definitely seen that too. And I think Shriram talks about it a lot on the Web 2 to Web 3 talent migration.
It's
But
pretty much my entire day, every day.
right, but why do you think that is? Like, is it because it's like new and shiny? Is it because, somehow they see that this is the future? Like, what do you think's going on?
Well, look, I think, the intellectually honest answer is anytime people are making a lot of money, it's going to attract attention. And so then people kind of say, well, hey, why can't I participate in that? But I think at a fundamental level, and if you can kind of get past some of the price, headlines, noise, I think it's a greenfield opportunity for people to build new things. Whereas in mobile, which is a much more mature category, we're 14, 15 years into that deployment S-curve, and you come up with an interesting new feature for a mobile app, and all of the incumbents have it cloned within a few months, right? Whereas, for example, Facebook had this big crypto effort, tons of publicity, had 1,000 people working on it, and I couldn't get it launched. And that's not for the talent of the people working there. It's actually more structurally. I think a lot of big companies have a very hard time wrapping around the complexity of crypto, because it is actually part of technology that is very entwined with regulation, and not local regulation like Uber and Airbnb, like federal regulators, people who can actually review it. And so I think that traditionally a lot of tech companies have shied away from those areas. And so when you're dealing with kind of the wild west of permissionless public blockchains, when you get to the finish line and ready to go to launch something, all of a sudden, the legal and compliance people at some of these larger companies are like, hold on, like we need to make sure we get buy-in. Whereas if you're a crypto native firm, like you've never known anything different. And so I like to think that every time I see this, and I remember when I was at Coinbase, when Facebook was announcing this, and there were some people being like, oh my goodness, they're going to come in and they're just going to take over the entire market. My opinion was just like, if you're not 100% all in on crypto, it's very hard to dabble in it. And I think so far that's turned out to be the case. And I think we saw even a lot of last year, when there was a lot of interest in NFTs and Web3, they floated the idea of doing something in NFTs with their user bases, and people kind of freaked out. Whereas that hasn't stopped entrepreneurs from building a crypto native game on chain, or building new things that just from the ground up are built with crypto.
I think this is probably my favorite topic, right? Like, I think almost every day I get a DM or I talk to somebody who's moving from Web 2, like a FANG company or a classic mobile app, to Web 3. I think I see a few reasons for why this is happening. I think the biggest part is actually not the money. It's actually not because I see people getting rich. It's because it's just more fun. It feels like greenfield technology. It feels like something that you have to go learn. It's very new. The systems have not been designed. And how many times can you go write a React app that talks to a MySQL backend? And it's just more fun. And I think with the discussion in Twitter, in the press, just misses this of how much fun it is to go design a token, to go, figure out, all the trade-offs between what chains to use. And I think that's just so motivating for builders of work. I think that's number one. I think number two is there's almost this philosophical angle to where people just don't want to live in a world where power is centralized, in a few companies. This is not the internet we signed up for. This is not what even Web 2 was supposed to be about. And we have wound up here, and and all of our careers have benefited from these companies, but this is not what people signed up for. And I think there's kind of like a philosophical push towards maybe even like of a populist bent to say, hey, let's give power back to the people. And that comes up a lot. And not in sense of like, hey, we don't want censorship, we don't want moderation. There is definitely a lot of that. But more in terms of, I want something which is permissionless. If I want to go build an app, I want to go build a client, it should be like building on email. Like if I have to go, Aarti knows this. When I get really bored and I have too much free time, I will use Emacs and I will set up GNUs and connect to Gmail. There's kind of 100 different steps that you have to go do this. But I will set it up, and Aarti will know that I have too much free time. But the interesting thing about that is you do not need anybody's permission to go do that. You don't need Google's permission. You don't need the inventor of SMTP or IMAP. But if you go think about the Web 2 APIs, you don't need Facebook's permission. You don't need Google's permission. You don't need Twitter's permission. And I understand why that happened. But in Web 3, the idea of permissionless innovation is powerful. You can again go build on things, and guess what? You build on something, you go to Etherscan, it's live, and I think that's such a powerful thing. So I think all of these is the conversation I have every day.
Yeah.
And to be honest, I haven't seen them stop. The last week, look, prices are down, and it's not a great week for crypto. But I still get the same DMs from Facebook engineers, Google engineers. I don't see the flow of talent stopping at all.
True. Look, I agree with all of that. I think all of that is true. But I do want to call out, Dan, like I really appreciate your intellectually honest take, like that one that you just started out, which is it's hard to not look around and see how much wealth has been generated in the world of crypto. And for people to not get attracted to that and think, oh, maybe I should go give it a shot. I want to see what's out there, especially if you're an engineer, Web2 company, you've done reasonably well, you look around, some peer of yours is like jumped into crypto like a couple years before you, it's just way wealthier, orders of magnitude wealthier. It's really hard to not get tempted by that. So I do think that's a reason too. But I will say, having seen how the last week has been, and this might be this person's first crypto winter, so this might actually be like this true test of whether you really want to stick it out and go through this, or to what you had said, Dan, earlier on, Coinbase having gone through 2 crypto winters, and people just being like, I think I'm done, I just want to leave. And is this a time where you kind of cut your losses and cut and run, because this is just really not meant for you? So we'll see how it shapes up in the next few weeks, months, years, whatever happens here.
Yep.
Well, one thing I would say is, so in 2014, we definitely had what I would think of are kind of opportunists, people who showed up to Coinbase. It was a hot company. Crypto, Bitcoin at the time was very, very trendy. And those are most of the people who left during that kind of sideways period. And what you ended up left with were the people who actually cared about Bitcoin, right? They were the types of people who bought into the Ethereum presale because they thought it was cool. And so you had a very nerdy culture. And I mean, there's so many people from that era of Coinbase who've gone on to do, Antonio at DbyDX, Olaf started Polychain. I remember Olaf, so he's the first employee at Coinbase. He was lumberjack prior to Coinbase. And
wait, what? I did not know this.
Oh yeah, I mean, there are a million Olaf stories, but Olaf leaves in the summer of 2016, and he says, I'm going to start a crypto hedge fund. And I just remember sitting at the lunch table saying, Olaf, your qualifications are lumberjack and first employee at Coinbase. Like, what do you know about running a hedge fund? And he's able to kind of raise it. It wasn't a big raise at the time. I want to say it was like $10 million or something small. But he raises in the fall of 2016 and invests a bunch in Ethereum. And obviously 2017 is a very good year. So I think that era, the types of people who stayed at Coinbase were actually there, kind of mercenary missionaries. Like that was a group of missionaries, people who actually fundamentally believed in it. And I would say the last 2 cycles have generated 2 generational companies within crypto that are very, very oriented towards people who really were there for the mission. And the example from the first cycle that I was there was Coinbase, right? Is the kind of exchange in the US that stuck it out and was there. And then in the 2017 cycle, NFTs became a thing. And OpenSea was one of many marketplace companies for NFTs, right? It was a very like kind of, okay, like someone's going to be eBay for NFTs because they're slightly different than crypto trading. And most of the other companies just pivoted out. They're like, NFTs aren't going to happen. This is not going to be a thing. And it's the persistence for the people who actually care about the mission and the underlying belief in like, this is going to be a big thing, that when the next market picks back up, they look like geniuses. But, that was a team that had extended runway, made sure that they could make it through that winter when, I don't even know what the price of CryptoPunks got down to. They were crazy, right? But OpenSea continued to innovate and ship features, and then NFTs become a thing, and then everyone treats them like they're IBM or Microsoft. It's like, well, no, they were a very small company for a very long time, and the space blew up.
Yeah.
One of the like people often ask me like, is San Francisco and the Bay Area still relevant given COVID and all this stuff? And I think it's obviously like incredibly relevant. And I kind of I often think that the Bay Area is now the tech epicenter, but it's not the frontier. And the frontier is really working in Web3 wherever you are, with heavy emphasis in the Bay Area, New York, and a few other places. You're obviously in LA, Dan, or a bunch of people are in LA. So one thing is I really do think culturally it's the true inheritor of the tech mantle in terms of innovation and openness and trying new things and experimentation and all that stuff. To your point on Coinbase and OpenSea, I think a lot of people tend to conflate what exactly type of company they're working on and what the underlying business model is, and therefore what they should be doing. Are they building a protocol? Are they building a marketplace or effectively an index on top of a set of tokens like what Coinbase or OpenSea are doing? Are they a SaaS company? And I think depending on which of those three things that you're doing, how you run the company and how you think about what you're doing matters enormously, including cash management actually, as a part of that, because it impacts your dependency on the market as a whole rising. I think one other sort of thing I've been wondering about recently is if you look at each crypto cycle, the things that do very well financially, that doesn't mean they necessarily sustain, but the things that do very well financially are the concepts or notions that were prevalent in the prior wave, but weren't fully substantiated. So in 2017, suddenly you had Ethereum and all these altcoins, and it was the first L1s that really the first layer ones that mattered besides Bitcoin in a real way. But there's all these notions floating around, right? There was ERC 721, which became NFTs, and there's all these other things that people were talking about, DAOs, NFTs, a lot of the things that are now hitting now. DeFi was there's a lot of conversation, but Uni and other things didn't exist. And all those things now monetize in this last wave. And I almost feel like there's all this stuff that was created in the last year or two that hasn't quite become as massive as it will be in the next wave. And maybe that's certain types of layer twos and side chains, or maybe it's, you can kind of come up with a list of the things that haven't gone through the crypto pump and like die cycle or pump and succeed cycle. And I feel like you can almost be predictive right now in terms of what are the little things that are super interesting around social or around identity or some of these other concepts.
I was going to say, I mean, that is spot on. And I'm going to say this because I think Dan may be too bashful to say this. I think Web3 and social is probably one of the most interesting things happening right now. And part of the reason I think for that is it's kind of tied to what I spoke about before, where it feels like the time is right in the zeitgeist, where there's kind of a pushback against centralized power. There's a pushback against platforms having control, and you come in from different philosophical angles, and
data ownership,
maybe they're not politically aligned with you, but I think for a lot of reasons where you just want sovereignty. And I mean, Dan, you should talk about that. I mean, you spend all of your day thinking about this, but I do think this is the time for Web3 social. So yeah, Dan, I mean, this is kind of your thing.
No, I think Alad's framework is spot on. Is if you were to say, how do you kind of find, if you're a founder or someone trying to figure out, should I be joining this Web3 company or not? I think looking for the companies that are trying to do things that are new, and kind of are crypto native and are uniquely enabled by crypto, things that haven't existed before. Those ideas tend to be, and Chris Dixon has a good framework for this. They look like a toy. Like everyone makes fun of them. This is so stupid. But there was a very high profile article in the New York Times in 2017 that was making fun of CryptoKitties. And obviously Dapper Labs has been incredibly successful. And that CryptoKitties was the first version of something that ultimately led to Top Shot. But at the same time, CryptoKitties actually was a kind of predecessor to all of these other projects that exist out there today. And so if you actually really want to look for a heuristic, is the more someone is dunking on something on Twitter where they're probably not in crypto, it's probably worth you understanding what that thing is, especially if it's new and weird from a first principles standpoint, and actually apply a lens as a builder to say, what is this uniquely enabling? Like what thing can I do now with this that I couldn't do before? And I think like a good example is the founder of Vine, Dom Hoffman, who had sold his company to Twitter, which basically was TikTok before TikTok. So the guy clearly has a lot of creativity. He just had a tweet, I think this week, where he said, I deployed my first smart contract a year ago. And what a year this guy's had in terms of his, he created Loot, like Blipmap, like all these different projects. But going back to Sriram's point, he's just been having fun. He like made a Tamagotchi at one point that you could keep alive, and you had to start on transaction, and it was kept alive for some period of time, and then it ultimately died. But that wasn't a company. It was just him having fun, remixing some Solidity together, putting it out on Twitter. And I think part of that is the culture of crypto you see on crypto Twitter that everyone makes fun of, is like the GM component of things. It's people not taking themselves too seriously. So it actually allows them to experiment a little bit more. And I think sometimes Silicon Valley, just given how big things have gotten with tech and the kind of tech versus media and government stuff is there's a whole angle of the crypto that is actually just kind of fun. And it feels like the early days of Web 2, or, I mean, I wasn't around in the early days of the web, but it just a lot more playful and a lot more like, this is kind of weird and cool. Let me put it out there.
Yep. Yeah, I love that. I'm really glad you called it out, because for me, at least personally, that was one of the things that really excited me, where it's like, it almost feels like we now have this next generation set of suits in Silicon Valley. And then there is now crypto, which is just this breath of fresh air. Everyone's just like, I'm doing this thing. It's like, it's a fun project. And you can also tell people who are like outside of this circle, where they if they don't get it, they're like, oh, that's so dumb, that's so stupid, I can't believe you're spending all your time on this. Oh, like, right click and save for the NFTs. And you have this like whole set of people who are just like, trying to push back on it. But you do see this like crypto community of people who are just doing this because why not? It's just fun, it's silly, it's goofy. And for the first time in their lives, they can actually like work on something that's just because they just want to do it. And it's just really fun. And I love that.
So. I love it. I think, maybe that's probably the perfect note to end on tonight, because it's fun. So crypto is fun. So,
crypto's fun. I think, I think with the downturn and everything, we don't know, like, none of us can predict. We shouldn't predict, as Mark says. But I think it's just, no matter what happens, I think for builders, this is still a really great opportunity, I think, to just, use the moment to be aggressive, to go out and, figure out what is it that you want to go build, go have fun in the building process. Because I think the best companies come out of this downturn, no matter when it ends. I don't know if it ends next week or next year, but just, carpe diem this day and just like go after it.
Love it. I love it. Okay. On that note, carpe diem, have fun, but know your runway. And I want to thank everybody. I want to thank especially, first of all, on the crypto side, Dan and Elad, thank you for sticking around. This is just so much fun. Amazing. Thank you, folks, both. Elad's really kind of like the grand old statesman of Silicon Valley, seen it all, and, kind of the person you go to for advice, when you want to see things. And earlier on, just want to also thank everybody else who joined us, David George, Sinab, Steven, and the one and only Mark for all things. But this was a blast.
Yes, this was great.
This was super, super fun. And as always, let us know thoughts, comments, hit us up on social. Go like, subscribe.
Guess you want to see all of that. But yeah, if you want to find us, we are on YouTube. Subscribe so you'll get notified on the next episode. And we will also be on all the podcast platforms.
We'll be everywhere and on Web3 soon, I think. But until then, we'll be back next week.
Yep.
Have a great night and stay safe.
All right. Sounds good. Thank you, folks.
Thank you. Bye.